Hi, my name's James Johnson. My expertise lies in retirement and estate planning. And today I'm going to talk to you about IFR. IFR stands for increase, flatten, and reduce. Now, what does this have to do with? Well, this has to do with your taxable accounts. You see, most people have money stashed away inside of brokerage accounts, CDs, these types of things. And these create taxes on an annual basis, or what are called 1099s. So when taxable accounts generate interest or dividends, there are three ways to pay these taxes. One is an increasing tax liability. Two is to pay a level or a flat tax. And three is a systematic tax reduction. Now, this is important because one of the largest transfers that's going to take place throughout your lifetime is going to be taxes, not only while you're alive, but when you pass the money on. So we're going to use some assumptions right here. We're going to start off with a current age of 60 years old. And we're going to say they're going to accumulate their money for the next 20 years. So their life expectancy is out to age 80. We'll start with an initial balance of $500,000. We'll use some very conservative numbers with regards to what their growth will be on the account. We'll use 5% across the board. If you want to sit down and do this individually, I'll do any numbers you want to put inside of here. Ordinary tax brackets will be 40%. So what this says is that their top marginal tax bracket is 40%, and this includes not only the federal, but the state. And yes, that will be different for different cases and different individuals, but let's just follow along here, and then at some point, if you'd like, we'll sit down and show you this individually for yourself. So when we go out here and we compound interest on this $500,000 and we invest this money, the account gets larger every year. So as you can see, as we go down each and every year 2, 4, 5, 6, 7, 8, 9, and we get all the way down here to year 20. And by year 20, we have $1,326,649. Now, this is if we didn't have to pay any taxes on it along the way. Our account would have accumulated to $1,326,649. Well, of course, we probably are going to have to pay some taxes because it's tax as we go. Well, when you compound interest in a taxable investment account, your account grows dramatically. The taxes increase along the way, meaning that every year those taxes will be higher and higher and higher. So let's go here and take a look at what that really means. So we can see over here that we have two columns. We have interest, tax, and the compound investment. So as we go down the line here, you can see that each year that annual interest is $44,896, then it's $47,000, then it's $49,000, and each year we compound inside of that account, the taxes are going to increase going forward. Now, why is this important? Well, if you're using a CD as an example, and you're over here making 5% inside your CD, how many of you actually reach into your CD and take that money out of the CD to pay the taxes? And I can tell you, it's a very small handful of people that do that. What they actually do is they take that money out of what we call lifestyle, and they remove it from their lifestyle, and they pay the taxes out of their lifestyle. So at the end of the 20 years, yes, they still have $1,326,649, but they paid $330,660 in taxes out of their lifestyle. And if you were to take that away from that, you would be down to about $1 million. But see, you have to also calculate in the lost opportunity cost on those taxes. So if we calculate in the lost opportunity cost on those taxes over that period of time, we have another $174,730 in money we would have had otherwise. So take your end of the year balance on your compound interest, subtract out the taxes that was paid, and the lost opportunity cost, and your net balance at the end of the day is $821,259. Now, hopefully I went slow enough for you to understand that. And if I didn't, always feel free to set up a no cost, no obligation, a meeting with us, and we'll sit down and we'll actually show you what this looks like in your situation. But let's move forward here now. So if we use a flat tax alternative and move the earnings only, in other words, take the earnings out of the account and use that to pay the taxes, or we reduce the tax alternative by moving principal and interest either immediately or over a period of years, let's look at those two options. So for starters over here, you fully understand the value of flat tax strategy. The accumulation value, the withdrawn interest must be added back into the original principal. So we're going to look at this in two different scenarios here. So let's start off here. We have that $500,000. Now, what we're going to do in this particular case, as you can see as we go here, we're not going to accumulate the money inside of this account over here. We're going to take the growth out each and every month or year throughout that period of time until we get out here to the 20-year point in time. And by paying those taxes with outside money and taking that money out of that account, we end up only having to pay $124,438 is our opportunity cost, plus the $190,000 we paid in taxes. And our net result over here is $871,552. So we'll go out here, take a look at our account number 2. Now, if we were to take that money and we were to put it over the growth over into our tax deferred account and grow it on a tax deferred account, then what we would see over that period of time is that it grows up here. And now we have $871,552 in the tax deferred account. The taxes we paid, so we take our net account over here, plus the taxes that we paid and our opportunity cost, and we end up with $871,552. So let's go out and take a look at what would happen if we move that to tax-free. So if we move that into tax-free as opposed into tax-deferred, we end up out here with $1,011,735, a little bit better. Now let's look and see what would happen if we used a reducing tax alternative. And the reducing tax alternative is, as the principal declines to zero, the amount of earnings in the account and taxes paid on those earnings declines proportionally. So we'll take a look out over here. And we can see here, so here's our $500,000. So now what we're going to do is we're going to move that $500,000 out of that account and over into the tax deferred account, or tax favored account, as we refer to it. Now, let's say that we wanted to do that. Let's just do it over the 20-year period of time to start off with here. So as we're going, we can see that our balance over here, our end of the year balance, is dropping on this account, and we're slowly moving that over into a tax deferred or tax favored account. As we get down here and we get to the end of the 20 years, we have zero left in this account over here. We only paid $105,000 in taxes. We only had a lost opportunity cost of $94,000. And now we have $1,326,000 over here. Take that away, and we end up with take away the cost over here. We end up with a balance of $1,126,945. Now, if we put that in a tax-deferred account, we end up over here still having a tax defer amount over here of $224,000, and our net result is $901,971. So let's go back, let's just rewind the clock here just a little bit. And what if we, instead of taking 20 years to move that money out over into, let's say, tax deferred, we did it over a 10-year period of time. So now in 10 years, we're going to reduce our taxable money and get it into tax deferred and or tax free or tax favored. As we do that, we get out over here. And as you can see, we end up with $939,000 in this account, and in a tax favored account or tax free account, we end up with $1,223,067. So if we go forward here and we take a look at what we've actually just looked at. Now, I know I went relatively quick for you here, and you can always go back and rewind this and watch it again. And listen, I'd love to hear your comments. So in the bottom down here, below this video, be sure to put in your comments and any remarks that you have with regards to what your ideas are on whether you should use an increasing or flat tax or immediate pay down, and whether you think taxes will be lower, higher, or the same in the future. But you can see here, by using increasing tax, we went out here, we had a balance at the end of the year of $1,326,649. But the taxes that we paid out of our lifestyle money was $330,660. If we use the flat tax model, it was $190,476. And if we paid it down immediately, if we just simply moved it over and then we grew it tax favored from that point forward, or tax favored over here and tax free over here, we had zero in taxes here, but now we have a tax deferral of $330,000 here. Over reducing it in 10 years, went to 46 and 56 and 1.23. So what were the final results? Well, the final results were, by using the increasing tax, or paying like most people do, simply reaching into their pocket and paying the taxes as we go, our net result was $821,259. On the flat tax, we ended up with a net result of $1,011,735, and that's an improvement of $190,476. Not a bad number over a period of 10 years, about $10,000 a year. In an immediate pay down situation, we got here to $174,000, and by going over here and reducing it in as short as 10 years, we improved it by $401,808. I would say that this deserves really paying attention to if you're concerned about how much money you're going to transfer wealth-wise with regards to your heirs. If you have a taxable investment where interest is compounding, you have observed that. Compounding interest increases taxes. Leveling your taxes creates less wealth transfers. Reducing the tax liability by repositioning principal and interest can potentially further lower wealth transfers based on alternative investments. Now, I hope this was helpful for you to begin to understand why getting proactive at this point in your life, no matter where you are in your life, getting proactive about your retirement planning and your tax planning going forward can make such a huge difference. There are things like Roth conversions and growing your money tax-free and IULs, and I could go on all day long. But at the end of the day, you have got to begin to understand that if you do nothing, that is having a plan. And the plan is to pass that money on to the government rather than pass it on to you and your heirs. I look forward to meeting each one of you in the near future. Keep smiling, and remember to subscribe to our channel below, and be sure to put some comments in here. Can't wait to hear what your comments will be. Make it a great day. Bye now.